Welcome back to Trading Day. The price of oil slipping today after a run of gains. Apparently, the algorithms carried oil into overbought territory, according to our Bloomberg partners. But oil apparently breaking out of that tight trading range that saw it stuck between $70 and $80. Let's get more from Bob Yawger, energy future strategist at Mizuho. Bob, it's great to see you. I mean, among other things, you're keeping an eye on those Ukrainian drone attacks on refineries. And you cite one strategist who says if the Ukrainians really wanted to hurt Russian oil sales, they could attack the export terminal, but they've held off from doing that.
They have. That would be a big leap forward, Andrew. If you see that headline hit the tape, they've gone live at that point. It's gone to the next level. There's two big giant Russian export terminals. One's on the Black Sea, one's on the Baltic Sea. And they move over 1 million barrels a day, well over 1 million, up to 1.5 million barrels a day. And if they were to be attacked and shut down, you would see corresponding prices for gas oil / diesel and heating oil, and also for flat out crude oil rise exponentially. Not exponentially maybe, but they would rise a couple dollars. So they have not really attacked them yet. They're off limits at this point. We are trying to tame inflation here in the West, and we don't need our Ukrainian pseudo brothers here lighting the inflation lamp in the pursuit of a victory in the war.
So wouldn't maybe sit well with the White House as an election nears, something that pushed up gasoline prices?
That would not help. And our European partners would probably be not too happy about that either. It is putting pressure on the Russians, though. I mean, they are feeling the effects. As far as winning the war, you got to choose your poison to a certain degree. As far as winning the war, if you take those two terminals out, that's a big difference.
Whoa. That's interesting, isn't it? I want to get your take on this as well, Bob. You've been watching the oil market for a while. You guys buy a lot of oil from Canada. In November, it was about 4.4 million barrels of Canadian crude a day. We were something like 63% of your crude imports. So Canada is about to open up that Trans Mountain pipeline, which will give us offshore sales of oil. I know we've already had some oil going through the pipeline, but a lot of it ended up just at U.S. refineries. But now we may be able to sell more directly to Asia. Do you think the strategic councils in Washington are wary of that? Presumably America would like to have all that Canadian oil to itself.
Yeah, I agree with you 1,000,000,000%, Andrew, but it doesn't really seem to be ringing the bell out loud. We're getting that crude oil at a huge discount. That discount is going to evaporate rather quickly. You're going to start moving barrels. The West Coast will pick up a lot of those barrels. Refineries in the West Coast, California, Washington State will pick up some of those barrels. A lot of those barrels will go to Japan, South Korea, and China, though, even India. And you know what? You're going to get a higher price for them. The Canadian entities that have held out for this long, committed for this long, taken a $6, $7, $8, $9, $10, $15 beating for years on end, they're going to start to profit handsomely off of the back of this. But I got to tell you, it doesn't seem like anybody's really making a big deal about it here. And that rug is going to get pulled right out from our mid-continent refiners. That stuff's not coming down the pipe at a gigantic discount for much longer.
Although one analyst, Michael Dunn at Stifel, he says, it does depend because those mid-continent refiners might cut back on their usage of Canadian oil. And of course, that would reduce demand. So the discount, of course, is likely to narrow, he says, but it may not narrow that much.
Yeah, we'll see. I mean, that's a big thing about refiners. They're always adjusting and maneuvering to take advantage of the cheapest barrel that they can run through the refinery. Keeping in mind, ultimately, at the end of the day, you really always want to make gasoline and not distillate. So if you can do that, that's the direction you have to move. And they're going to have the U.S. mid-continent refiners going to have to scramble a little bit to make to maximize margins, though. If those barrels start to go out towards the West, that's just the way it is. We had the same problem back in the day when we lost basically Venezuelan barrels. That was a heavy crude that we got cheap at a nice discount. our refineries in the South were, some of them were configured accordingly. And once the Chavez government pulled the rug out on us, we had to change the configuration of those refineries, and that's not cheap. It's not something you push a button and that happens. You got to take that refinery and make it different, basically.
Bob, we've only got 30 seconds, so sorry about that. Where do you see oil going much higher from here?
There's a chance we go higher, and it's all going to be on the back of gasoline. Gasoline was traded higher. It got overbought this week. That's why we're trading lower. Gasoline pulled back before crude oil. It's taking crude oil down with it. But we're still 2 months away to gasoline season, driving season. If gasoline takes off, it's going to take crude oil with it.